Good morning, real estate mindset community. Welcome to another morning live and happy Thursday. We have a lot to talk about today. CPI came in absolutely hot, so that has had profound effects on the market already this morning. But I wanted to ask you guys a question. Have you also been noticing, especially on YouTube, specifically on YouTube, have you been noticing that some of these bulls, realtors, these realtor channels have been adjusting their narrative to start warning you guys about the housing market crash? Have you guys seen that? Because I have seen that as of this morning. It was really difficult to watch this video. But basically, I'm just going to say, because I don't want to bash anyone, but let's just say the queen of the YouTube cult, which is the YouTube lead generators, the queen has started saying that she expects the housing market could possibly crash in 2024. I find that, you know, typical, right? A lot of these people, all they're going to do, guys, is just adjust their narratives because they've milked you for all your money. They've milked people to purchase for all their money. Now, the crazy thing about this video, because again, these people are starting to shift their narrative because they have no choice. But this lady basically was saying that, do you guys think that there's going to be, 2024 is going to be another year where home values go up 15%? Implying that this year home values are up 15%. So when I heard that, I'm like, what is this lady talking about? Like, bless her little heart for changing her narrative and warning people, but she still has everything so wrong. 15% increase. So I went to Redfin and I checked the number one metro area, okay, which is, I think it's in California, but it's not even up 15%. Even the number one metro area is not up 15%. In fact, overall, home values are up right now, what? Less than 3%. So home values are up 3%. So then I was asking myself, is this person who, by the way, I believe created the term crash bro. So this person is now adjusting her opinion. She's been, basically slamming us the whole time. Now she's adjusting. So I'm like, maybe her market is up 15% year over year. And this is why, you guys, you can trust people all you want, but verify. Trust, that's fine, but verify. So I went to this lady's home state just to see, is her home state up 15%? Look at this, guys. This own lady who has been bashing us this whole time, making a claim this morning, I watched the video this morning, saying house values are up 15% in her own state. In her own state of Louisiana, home values are down 1.4% year over year in her own state. And the reason I'm telling you guys this, don't forget, don't forget all the people out there that have been pushing this narrative to just purchase this entire time, because I'm going to tell you right now, these people are just going to flip their narratives and they're going to act like nothing happened. So just be careful on that, you guys. Pretty despicable. But where I want to start is I want to show you guys what I've been doing over the last few weeks and the last few days. Now, I've been a little bit radio silent on my emails. I'm sorry, you guys. There's only so much time I have. I'm a one-man army. And what I've been doing recently is really just trying to give back to you guys. I've been searching my heart. What do I want to do? How do I want to help society? What is my legacy? And my legacy, I want my legacy to be about empowering normal people, not making money. I want it to be empowering. So I've been working on a home buying class, and I wanted to show you guys so far where I'm at, because maybe some people don't believe me, but take a look at my curriculum. Okay, here's my curriculum. This is going to be ready hopefully by the end of this month. I'm not sure, you guys. I may release this in sections. This is going to be free. Okay, so I want to be the guy that actually walks out what I'm saying. So this is going to be free, but take a look at my flow. Take a look at my curriculum. So I'm going to have a section on purchasing power. We'll have several lessons on credit, income, assets, and mortgage. And then another section is going to be on creating goals and planning ahead, where we talk about treating your primary residence like an investment. We're going to talk about the differences of price versus payment. We'll talk about buying incentives. The next section is understanding local market trends, where I'm going to teach you guys more in depth about wedge, cash flow, and market analysis. And then the last section is finding the right professionals. I have people asking that all the time. So I'm going to tell you guys what to look for in a loan officer, in a realtor, insurance provider. This is going to take me some time, you guys, because take a look at, let me show you the first lesson. This is credit. So it has a nice little lesson summary. We go over utilization ratio. We go over really important things about credit, how credit works. And then, I have the little training video right here. And then the reason why this takes long is because I really want you guys to learn and I really want you guys to retain the valuable information here. because my plan is, again, to help the normal consumer purchase their primary residence. But I'm going to be teaching you guys things that I've learned over 22 years. So I'm going to be teaching you pro status stuff. So basically every chapter and lesson is going to have a quiz for you guys to pass. Like here's the first question, and I hope you guys know this. What is the max utilization ratio recommended? Do y'all know that answer? I hope you guys know that answer. So anyways, so that's what's going on right there. I apologize for being a little bit radio silent, but this is really important to me. This is kind of like what I stand for. It's kind of what I stand for. So it's a really big deal. But anyways, guys, we're going to get right into that market update right now. Let me put my first timestamp. Sorry for rambling so early this morning. I apologize. But let's go into the CPI report because CPI did come in hot, and I'm sure you guys can guess why it came in hot. The leading thing was obviously shelter. So let's go over this right now. Here is the CPI index summary. Again, this came in hot. This came in above expectations. This shot the 10-year up as well. I'll show you guys that in a minute. And also changed the CME FedWatch tool when this came out. But really, this is all it's saying about shelter. The index for shelter was the largest contributing to the monthly all items increase, accounting for over half of the increase. So shelter was over half of the increase for CPI. So again, shelter is really important. So anytime, people are saying, oh, the battle on inflation, it's working. No, it's not. It's 100% not in shelter. That's what we've been watching. Again, I know people are watching eggs and bacon. I know gas is important. I know electricity is important. But really, really what's important is shelter. And that's going up. It's actually accelerating. Let me show you guys a couple things, okay? So here is, let me raise my picture here. Okay, so here's the report. Again, we're sitting at 3.7. This was higher than expected. Let me show you guys a couple things that I noted here that I thought was interesting. So what I also wanted to point out, and I know we don't really cover this on our channel, but used cars and trucks. So the used car market is actually deflating. That's really good. So it's actually down year over year, 8%. So that's good. And month over month, look at this giant drop, you guys. This is, that's pretty substantial, 2.5% drop in 1 month for used cars. Really substantial. So I wanted to highlight that because we see the cracks happening right now. Not necessarily yet in the housing market, although we have definitely seen cracks, but we're seeing deflation consistent with used cars. That's really, really good. So it's working. What the Federal Reserve is doing is working. Is it working fast enough? Maybe, maybe not. Maybe we want it to be faster, but take a look down here at shelter. Shelter came in hot. It came in really hot, actually. It came in at 0.6, and that is a rate of 7.2%. So right now, I think it's fair to say, because interest rates have been skyrocketing, I think it's fair to say that right now, we can say that there's basically runaway inflation in the housing market. Now, obviously, that's stopping. They finally had that stop. There was liquidity that's being drained, things of that nature. So it's just been taking some time. Unfortunately, it's been taking time. All that means, you guys, is that we need to be more patient. So I'm going to start us in right in our first video before we actually do the market update. And the reason I'm going to start with the video before the market update is this video is going to go into what was released yesterday from the FOMC meeting. So this is going to go into what the Fed is basically saying they're going to do next with their inflation battle. So that came out yesterday. Here's a video on it. I think they're going to explain it a little bit better than me. If you guys can, let me know if the audio is okay.
At the time of their meeting, the minutes show Fed officials felt that interest rates were now restrictive and, quote, broadly restraining the economy as intended. Caution would be warranted in future rate decisions. But there was disagreement over whether rates were high enough to bring inflation down to their 2% target. While the vote to leave rates unchanged in a range of 5.25% to 5.5% was unanimous, other non-voting members of the policy committee apparently disagreed. Almost all participants judged it appropriate to maintain the target rate, the minutes say. A majority of the participants judged that one more increase in the target federal funds rate at a future meeting would likely be appropriate, while some judged it likely no further increases would be warranted. Supply and demand were coming into better balance, the minutes say, particularly the labor market. Pay increases were slowing, but inflation still remained too high. And, quote, a vast majority of participants continued to judge the future path of the economy as highly uncertain. Credit conditions were tightening, energy prices rising, the Chinese economy was slowing, and the U.S. faced a threat of a government shutdown. There were also concerns about the impact of the auto workers' strike and about commercial real estate. Still, all participants agreed that policy should remain restrictive for some time, and several argued the Fed should shift its communications from a focus on how high to raise rates to how long to hold them there. As for the balance sheet, the feeling was they could continue their passive rundown for some time, even after they begin lowering rates. Guys?
Not much of a reaction in markets, Mike. You can see 10-year yields still about 5 basis points lower. The S&P 500 pretty much unchanged since before the minutes came out. And when you look through the headlines, this one sticks out. Proceed carefully. It feels like that phrase has appeared many times, and we're seeing it again in these minutes. Should we take that as to mean that this Fed is going to stay on hold for some time here?
No, I wouldn't take that to mean that. I think it means that there's kind of a higher bar for a change at this point. They want to make sure that they aren't doing something that's against the economic best interests, given that they are in restrictive territory right now. We'll see what happens with CPI tomorrow, PCE at the end of the month. But as long as there are no surprises, they probably are still looking at not raising rates on November 1st. But
well, you guys, there was a surprise. This video was yesterday, so they did get their first surprise today, which was higher CPI. So again, it's very, very interesting because on one hand, you know, we have these cross currents, we have these headwinds, but on the other hand, we still have so much of that money printing that was done through COVID. It's still embedded in sections of and areas in our economy and in our market, and also the government is still spending money like crazy through all of that money. So there's money all over the place still, but excuse me, there's a lot of sectors, especially in the banking sector and commercial real estate sector, that is getting hammered right now. So let's move in, guys, to our house market update. But let me know what you guys think. You know, obviously, here's what's happening with the Federal Reserve right now. Let me explain this, and then we'll go into our house market our market update. So what's happening with oh my gosh, I just looked at the 10-year. Holy smokes. Oh, I can't wait to go over this with you guys. But here's what's happening with the Federal Reserve. They're not going to be asking themselves as much anymore if they should continue raising interest rates. So basically, they're like, okay, it's pretty restrictive. There's some headwinds and cross currents. And now what the communications are going to start shifting to, instead of how much higher, because again, they're pretty much probably done with the rate hikes. The next order of business for them is going to be how long, right? How long do they, oh my God, I'm looking at the 10-year. How long do they need to keep interest rates elevated? Now, why are they keeping interest rates elevated? Inflation, okay? Because things are so unaffordable for America. And so people would ask, well, why are they making them more affordable? Well, so people stop buying things and let things settle back down. So they're hurting us, making things more expensive to make it cheaper. Is this not wild to you guys? But anyways, we're going to go into our housing market update right now, our market update. Let me put my timestamp on our market update. And we're going to start with the 10-year, huge movements on the 10-year. I've been watching this all morning. 10-year right now, you guys, it's just so crazy how petty and emotional the market is right now. It's just so crazy to me. But the 10-year has skyrocketed, literally freaking skyrocketed. And look at this. You can see it right here. So I've been watching this. Like the first thing I do when I wake up, and I hate to admit this, the very first thing I do when I wake up, unless it's praying, I may pray, but I'm looking at the 10-year. That's what I'm doing every single morning when I wake up. So I was watching this all morning. I was like, okay, it's about the same. It's, the flight to safety. It's about done. It's about done. And then look at it was going down. I was like, okay, it's negative. It's going to be a little bit more negative. And then boom, look at that right there. That's freaking nuts. So now the reason this is because CPI came in hot. CPI, as soon as that report came out for CPI, it freaking skyrocketed. So this is people selling the 10-year. This is people leaving the 10-year, probably going into the short end of the yields right now. And why would they do that? Because maybe they think that the 10-year is going to be higher in the future, right? So let me show you the short end now. Now, again, remember the long end right here, the 10-year, the 30-year, this is what's killing the economy. This is the 10-year, 30-year, this is what's killing businesses. This right here is what's making it hard for banks to make money. Do you understand? Okay. So this is the economy crusher and killer, the 10-year, the long end. Now the short end, like the 6-month right here, is what I like to refer to as the liquidity zapper. And I say the short end is liquidity zapper because right now the Fed is doing something called quantitative tightening. So they're basically going to sell treasuries and they're going to take the money from the sales of those treasuries, and through quantitative tightening, they're going to make it disappear. They're going to delete it. They're going to burn it, say whatever you want, but they're burning away the money. So this is the liquidity zapper. And right now, 6-month is at almost 5.6. Now look at the 1 month. Now this is what I buy. Okay, so almost all of my down payment for my house and the money that I want to invest in real estate is in 1 month treasuries. It's in this right here. So this is where I've parked my money in the 1 month. The 1 month is, I mean, that's pretty good for a 1 month, right? It's at 5.42%. Again, this is the short end of the yield. This is the liquidity zapper. And you guys are probably like, what do you mean liquidity zapper? What do you mean liquidity zapper? And what I mean by that is liquidity zapper, meaning we need the money coming out of the overnight reverse repo market. We need this money to come out of the reverse repo market, and we need the Fed to burn it. We need the Fed to burn this money. There's $1.2 trillion in here, right? Yeah, $1.2 trillion in here. So this is the liquidity. This is the money printing, or this is some of the money printing. This is called the reverse repo market. Now, you may be asking, how do we get rid of this liquidity? How does this evaporate? Well, it evaporates by this 1 month interest rate right here, being at 5.4%. This needs to be higher than the 1 day, which is the reverse repo market, which is at 5.3%. So, and again, the higher that the short end, like the 6-month and the 1 month are, the more likely it is that money will continue to flow out of the reverse repo market. This is what's propping up our economy. This is one of the things, okay? There's a lot of things going on. I'm so sorry. I didn't mean to say the only thing, but this is one of the things that's propping up our economy. And this is what for lack of better words, this is where the Fed's borrowing money and then burning it from right here, the reverse repo market. This is incredible. This is absolutely incredible if you guys want to watch the money. So again, you guys, after that, here's another thing. So people are worried that what happens when the Federal Reserve stops raising interest rates, what's going to happen with residential mortgage rates. And I wanted to let you guys know, and we saw this in the letter that was penned into the Federal Reserve from the National Association of Realtors, Builders, and Bankers, that they're worried about this. Okay, so they penned in worried about this because this is what they don't know, right? Even though the Fed has already told us that they plan on selling mortgage-backed securities, they haven't. They've just let it basically roll off the books. Apparently they're selling a little bit in the secondary market, but people don't want to buy mortgage-backed securities because mortgage-backed securities right now some of them are the new subprime. What do you mean by the new subprime? The rates are 2 and 3%. To buy a mortgage-backed security right now would be losing money. The old mortgage-backed securities, right? Because today rates are 7, 8%. So in the past, what do you have? 70% of loans right now under 5%. I mean, people don't want to touch mortgage-backed securities, but nevertheless, they can still sell these and they can take a loss. Now, why is that important to us? Because it gives the Fed an ability to continue to manipulate mortgage rates. Because this is basically the federal government subsidizing the housing market right here. This is what it looks like. This is mortgage-backed securities. So I wanted to point out, it's going down, but it's going down very slow. But not only do we need to get rid of, all of this liquidity, hopefully we'll start seeing the Federal Reserve continue to sell mortgage-backed securities. And again, that's what has the industry completely freaked out right now. Now let's take a look at the VIX. Wow. Okay, so here's the VIX right now. This is a volatility index. This is actually sideways right now. This has been going down over the past few days, which is an indication that everything's okay in the economy. Okay, so when this goes down, that means everything's okay, according to the market. According to me, everything is not okay. But this actually also reversed. And the reason why this reversed, again, is CPI came in hot. Raise your hand if you thought CPI was going to come in hot. I thought so. Why wouldn't it, right? Take a look at the Dixie. The Dixie is very interesting as well. If you guys want to know, again, we're following the money. I mean, literally, you guys, look at the trajectory as soon as CPI came out. Everything we just looked at, massive skyrocketing. When did that happen? CPI. Why is CPI important? Because the Federal Reserve tightening interest rates. Why is tightening interest rates important? Because the whole market reacts to that because people make less money. Or do they make less money? Not really. Not if you invest it wisely, like in treasuries, right? But anyways, guys, the Dixie is up. It's actually at $1.627. Now, this is hurting the world. The higher that this goes, the more that it's going to crunch down on the world. Okay, because this is comparing the dollar to basically the world, and it's going up. But really, just isn't this just so intriguing how all of this is connected? I find it incredibly intriguing. I don't know about you guys, but I absolutely do. So we're going to go into our next video, and our next video is going to be about the possibility of an additional rate hike in November. And again, I'm going to show you guys, see me FedWatch tool here in a minute to show you guys how the market has literally changed in the past couple of minutes now that CPI has come out. But this is really interesting because it's going to paint the picture that, hey, that we're not out of the woods with inflation. We have some really good stuff going on if we want balance. And I want balance in our housing market so we all have a fair shake, okay? I want balance. That doesn't make me a bad person. But guys, inflation's still bad. Inflation's still bad. So very interesting. Listen to a few of these points right here. Basically, them talking about there is definitely potential for a second and last final rate hike this November.
Well, let's bring in Jordan Jackson of JP Morgan Asset Management, joins the conversation. It's good to see you again. So are we set up? Are we set up well, or are there still too many risks in your mind?
You know, I think very tactically, there are probably still too many risks in my view. When I say tactically, probably till the next FOMC meeting. I think it still remains to be seen whether the Fed will feel like they've got enough ammo or they can go on pause here. I'm a little bit more in the hawkish camp. I think they'll have enough evidence to maybe go again. When you look at the revisions to the payroll numbers over the last 3 months, the 3-month moving average has jumped up from 150,000 to 266,000. You could almost argue there's been a reacceleration in hiring over the last couple of months, and this is sort of further corroborated by the job openings number, which took a tick higher in August. We'll see how that shakes out in September. Also, when you look at the skew in the FOMC members, just about almost every voting member views core PCE as skewed to the upside from here, where you have no members that see core PCE as skewed to the downside. And then when you look at sort of the broader growth narrative, our numbers are converging with the Atlanta Fed's GDP tracker at now 5%. Our numbers are closer to 4%. But we're still looking at some pretty firm growth numbers. So you put all this together, and then last point I'd make, when you think about the inflation narrative over the next couple of months, autos, I'm a little bit worried about new and used cars with the strikes. You're already at low levels of inventories, and now the strikers add another layer of maybe inflation to the auto sector. So obviously energy as well being a wild card. And so, look, I think they want to put the last nail in the inflation coffin, and that skews me to be that they want to go again before the end of the year.
All right, so there's a lot to get to within that. The first thing I think of, Jordan, is when does good news just become good news? Why can't we accept the fact that we may actually have a soft landing? That, yes, job growth continues to be robust, but at the same time, and you left this out, by the way, wages within that same report came down. That is arguably more important than the headline number of how many jobs were added, is it not?
Well, remember, since the early 1980s, the average wage inflation rate has been about 3%. Over the last 3 years, consumers have enjoyed wage inflation of north of 4%. Now, I certainly acknowledge that it is in a downward trend, but now with where inflation is at today, you're seeing real positive wage growth, particularly amongst lower income consumers. And look, the reality is there's an old adage, a penny saved is a penny earned. But for the American consumer, a penny earned is a penny spent. So as long as you, absent a meaningful tick up in the joblessness or tick up in the unemployment rate, I still think consumption remains fairly firm over the next couple of quarters. And I don't think we move back to good news being good news until the Fed is done hiking. And that won't be until next year.
All righty. So they won't stop. Well, actually, they may have stopped hiking already. I think what he's talking about is cutting, because they basically stopped hiking. But one of the things that both those last videos touched on that I thought was really important is when we look again at sustainability and we look at the fundamentals and the fact that, what's going to happen? Prices going to go down 35%. Are we all going to make more money, 55, 60% more money? The interesting thing, and this is really the picture I'm trying to paint here, wages are not going up. Wages are going down. which is really an incredibly big deal. And a lot of people paint the picture that what's happening right now is more like the 70s and 80s. But y'all have to remember that during the 70s and 80s, wage growth was insane. There were some years during the 70s and 80s where wage growth was double digits. Right now, we have a Federal Reserve attacking the labor market, trying to soften it and trying to create unemployment. That is the opposite thing that we need to happen if people want the prices to normalize. If the prices are going to normalize, the home prices are going to normalize, then consumers need to make more money because if the values went up 40 to 50% in 2 to 3 years. A lot of people can't understand that premise, and it's okay. I understand it. But let's go on to our next thing. I want to show you guys interest rates right now. Okay, so interest rates are down only 2 basis points. This actually should have gone down more yesterday. I suspect that there's more room for this to go down. However, I now think this is going to go up. I think when this updates, it's going to go up, even though it's not taking into account the full hit yesterday. The reason I think it's going to go up again is the 10-year. The 10-year right now is up 8 basis points. So the fact that it's up 8 basis points, again, you guys, it's going to have a direct impact on the 30-year fixed rate mortgages. So maybe this is going to go up today, I don't know, maybe to like 7 basis points, 7.67 maybe, something like that. I don't know. But take a look at the CME Fed Watch tool right here. Okay, so here's what the CME Fed Watch tool is showing us after the inflation came out. Let me refresh this. Let's see if December has re-updated. Okay, so December, here's what the market's saying for December. Huge change. Okay, so you guys may have seen that, but there's been a massive change in what the market expectations are for this December as far as an additional rate hike. So additional rate hike for December is at now 40%. So when I started this video, you guys, I think we're at more like 20 to 30%. So we're at a 40% likelihood. The market is starting to wake up that higher rates for longer. A lot of people are still missing it. So again, I like to fast forward to the middle of next year because this is what we need to shut up all of the fake gurus on YouTube that are talking about seasonality and basically are completely naive and probably too young to understand what's really going on. So we're looking at middle of next year during buying season. And if you guys look to July, this has gone up. Thank God this has gone up. So we're at about now, let me do this in my head, about 30%. Okay, so when I, again, started this, I think we were under 20% or right at about 20%. So again, we see the massive adjustments in the sentiment in the market. Basically, you guys, the market doesn't know what's going on. That's why it's so important to look at all of this information, to look at the big picture. And then the final thing, to make up your own mind. What's with all the bullying with people wanting us to spend hundreds of thousands of dollars? I mean, honestly, guys, the way I was raised, we were like, okay, so the way I was raised, we would show an overwhelming amount of respect for people that had composure, that would save their money, that had discipline. So right now, people that do that are being bullied. They're being bullied. There's this whole premise that the government's going to take care of us. When did this happen? When did the American values start deteriorating? It's sad, man. I mean, it makes me really, really sad. And I do not want that for my children. So I'm really going out of my way, you guys. I hope you guys are doing the same thing to raise your children right. But we're going to go into our next video. Our next video, this is going to be a little bit longer. It's about 5 minutes. It's going to go into how the interest rates are starting to hit the housing market severely and how the housing market is sensitive to interest rates, and maybe the Federal Reserve should stop rising interest rates because the housing market may collapse. But anyways, you guys, enjoy the video. If you can, let me know that the audio is okay.
Is there a real chance for a Fed pivot? Here to discuss, Greg Dacko is chief economist at EY Parthenon. Peter Bookvar is chief investment officer at Bleakley Advisors and a CNBC contributor. And CNBC's Steve Leisman joins us as well. Welcome to everybody. Steve, help us kind of sift through all of this. What's the noise? What's the signal here?
Well, it's hard to figure out what's going on when a big shoe company is coming to market, Kelly.
Or
they
trying
are a shoe company, right? I'm just having a little trouble getting excited about a shoe company, but I hope that's not the cutting edge of American innovation. In any event, what's happening here is the Fed doesn't quite want to pivot yet. It doesn't want to give up the ghost of potentially hiking again, but it doesn't feel like it's going to do it anytime soon. And I'll explain to you a couple things. Let's look at Waller. Waller in early September told me he thought the Fed could wait and see. And that was like, oh, okay, so you're not going to hike in September, but that November hike is still on, right? Now he's saying, maybe not. We still can wait and see, which kind of takes November off the table. And if you look at what happened today, the probabilities we went down below 10% on the November hike. We're down, I don't know, 25, 26% on the December hike. So the market has taken that hike away. The Fed has not quite taken it away rhetorically. The only one who has definitively is Bostic from Atlanta, who said the Fed is, quote, sufficiently restrictive. That's the full stop phraseology right there. And I will tell you, every reporter in the press room, everybody who looks at the minutes today is going to do a word search on the word sufficiently to see if it's in the minutes.
And we should explain that's why you're there with those nice flags behind you down in Washington, waiting for those Fed minutes to be released in about an hour. Greg, the minutes matter to you today. What do you think the market is doing here with this big pivot on the long end? Is it fundamental? Is it technical?
Well, I think what Steve mentioned is absolutely correct. We are in an environment where the Fed has struggled really hard to commit to its message of higher for longer. So now that it has achieved that, there is a desire to avoid markets pricing in rapid rate cuts over the course of the next year. I think what we're seeing in terms of economic data is that we are in a disinflationary environment. We are seeing ongoing signs that this inflation is proceeding, especially if you exclude some of the bumps in the road from higher energy prices. And that should allow the Fed to essentially maintain its policy rate in the restrictive range where it is right now. But there is going to be this optionality of still proceeding with further rate hikes if there is the need to do so. That will remain part of the Fed's communication going forward.
Peter, what would you add to that? And what do you think is going on with the kind of global financial landscape more broadly right now?
Well, we definitely pushed the overbought condition to an extreme in terms of yields, the dollar, and the price of oil when it jumped above $90. So all of them sort of relieved themselves together. Oil came in, the dollar sold off last week, and yields have dropped. I think it's very important that a lot of Fed members have also talked about financial conditions, because you can't ignore the long end of the yield curve when you're trying to figure out where to put the Fed funds rate, because mortgage rates are directly tied to the 10-year. And mortgage rates and the housing market is probably the most sensitive part of the economy to Fed policy. So we've had a 100 basis point increase in the 30-year mortgage rate since the July rate hike. So the Fed had no choice but to acknowledge that and incorporate that in their modeling and how to figure out what to do with the November meeting. And I think that's why I think a lot of them backed off from committing to another hike.
Yeah. Sorry for misspeaking. Yields are moving up as a result of what Rick was just describing there, the collie tail on that auction. Peter, what were you saying?
Yeah, I think Rick is right that the geopolitics complicates the messaging that they're trying to glean from the long end of the yield curve.
In what sense? Because it seems like the major move has been people going back into treasuries, flight to safety, flight to quality, whatever you want to call it. Do you think that that's not legitimate? That it just has to do with the conflict that's erupted?
No, I think it is partly, but again, since their July meeting, the long end of the yield curve up 100 basis points is something that, regardless of why, it's going to have a dampening impact on the economy.
Yeah, no, it's a great point, and that's why we've started to hear the Fed speak like you're talking about. Greg, what would you add to that, and what further commentary is significant to you from Fed officials, whether in the minutes we're about to hear or in their remarks? I mean, if they're done, then what?
Well, I think it's very important actually to understand the why we're seeing this tightening in financial conditions. Over the early part of this week, I moderated the conversation with Lori Logan, the president of the Dallas Fed. And she highlighted that it was important to understand why long-term yields had risen. Is it inflation expectations? No, it doesn't seem like it. Is it the sentiment that the economy is more resilient and more inflationary? That, again, doesn't seem to be the case. Is it a higher neutral rate? Potentially, but that's not a big factor. Then it comes down to the term premium. Is it the fact that we're running larger deficits, less demand for bonds or less reliable demand for bonds, and potentially more inflation volatility in this complex geopolitical framework? I think that's the case, and that would be more reason for the Fed to essentially hold steady where it is right now.
Okay, guys, so I'm pretty sure you're starting to hear their narratives. You guys know that we've been listening to all these people for the last, 6-7 months? I mean, we're starting to see it change. We're starting to see people change because the data is overwhelming. The writing on the wall is overwhelming. I'm pretty sure most people know what's going to happen in the housing market next. What I believe is going to happen in the housing market next is what I've been saying is going to happen in the housing market next. I think that prices will continue to go down for the next several years overall in most metro areas. Now, when do I think things will get worse? I'm thinking possibly towards the end of 2025. The reason I think that is I also believe that towards the end of 2025 possibly is going to have the worst unemployment. The reason I think 2025 is going to have the worst unemployment is, well, we've already have massive corporate bankruptcies, but I believe in 2025 we will have the biggest amount of corporate bankruptcies than this year and next year. The reason I think we'll have the most amount of corporate bankruptcies in 2025 is that's the worst of the refinancing debt. So everyone knows, oh, commercial meltdown, everyone has to refinance. Oh, hurrah, hurrah, hurrah. But what a lot of people don't realize is I think that's 2 times more loans that need to be refinanced in 2025 than right now. 2 times more in 2025. So I believe, as long as we don't have interest rates in the 2 and 3%, I think that's going to be probably the worst of it. Now, again, that depends on what type of breaking happens. But anyways, guys, let's go into the recessionary indicators and some of the inflationary indicators because we've had an adjustment. Okay, we've been watching the 10 and the 2-year inversion. It's been skyrocketing upward to reinvert, which is really, really interesting. Now, yesterday, it finally hit a plateau. And I'm sorry, the day before yesterday, it hit a plateau. And then yesterday, it started inverting again. Okay, now, the reason why this is important, well, it's important for a lot of reasons. It's important. One of the reasons the reinversion is happening is because the long end of the yields, not the short end, which is normal. In fact, I don't think we've ever been reinverted from the long end. We're not reinverted yet. We were on our way. Again, the 10-year. But this has dropped back down. And you guys should know why. You should know why this has reinverted. It's reinverted because we had a massive drop in the 10-year treasury. So we had that massive drop in the 10-year treasury. Why do we have the massive drop in the 10-year treasury? Because the war in Israel. So the war in Israel dropped the treasuries. There was a flight to safety. And so this went back down. Now, what I suspect is going to happen is, depending on what happens in the world, this is probably going to start reinverting again. In fact, we know it's going to start reinverting again. Why, you guys? We know it's going to start reinverting again because look at the 10-year right now. The 10-year, when the CPI report came out, started skyrocketing. Look, you see it right there. So that's going to change today. I'm not sure when that's going to reinvert, but it has picked up a lot of pace. But again, it went way down yesterday. Look at that, way down yesterday. 11 basis point inversion in one day. That's pretty steep. All right, here's the 5-year break-even inflation. So again, this is very, very important for the Federal Reserve to watch. This is what when they talk about inflation expectations, this is one of the main things that they're watching, the 5-year break-even inflation rate. Now, they want this at 2%. I've been saying 2% or under. So they need this at under 2%. And it was making some pretty decent progress downward. We got to 2.14, but it has been going up once again. And I suspect that when this updates today, it's going to go up again. And the reason I think this is going to go up again once it updates today is CPI came in hot. Inflation is worse. Do you guys remember? Okay. Do you guys remember? And here's where I get frustrated. Do you remember when Jerome Powell, and first of all, it's his job to lie to us, okay? So that we don't know we're being boiled alive. But do you guys remember when Jerome Powell said inflation was transitory? Do y'all remember that? Why isn't it? Why isn't it transitory? Well, I would say predominant reason that is because it's stickiest in the housing market or in shelter. So again, if they wouldn't have printed the money into the accounts of consumers, maybe it would have been more transitory. But how the heck can things be transitory when we print that much money and you put it in the hands of the consumers that like to spend? Just saying, right? So anyways, guys, we're going to listen to our last video. Our last video is going to be from a former Dallas Fed president that's basically going to go into how sticky inflation is and how difficult it's going to be to get inflation to just under 3%. Just under 3% is going to be incredibly difficult. But again, this is our last video. There's lots of value here. A little bit boring, but I hope you guys enjoy.
Headline, September PPI coming in above expectations. Join us now with a look at how the Fed will likely view this number. Former Dallas Fed President Robert Kaplan, who's the co-chair of the Draper Richards Kaplan Foundation. Good morning to you. I'm putting you back in the room with Jay Powell on this morning. You just saw the numbers. You know the context and the background of where we are. What would you be telling him?
I would still probably do nothing in the meeting that's coming up in November. And the reason for that is we've had a very substantial tightening away from the Fed in the Treasury curve, and that will serve to tighten financial conditions. However, I do think inflation is going to be sticky. And it'll be sticky getting below 3%, and we have to leave the option open that we may need to do more in future meetings. But I would kick the can and skip the November meeting.
So you skipped the November meeting. When you look 12 months out, though, now, and you're talking about inflation continuing to be sticky, how sticky are we talking? I mean, there was an expectation even a month or two ago that we could see the Fed, lowering rates within the next 12 months, at least on the other side of it. But it increasingly feels like that's very unlikely to happen.
Well, it's still possible that could happen. We've got a couple of significant structural issues that the Fed is working against. One, we've got decelerating workforce growth. In other words, we don't have enough workers. And at the same time, the government is spending aggressively on the Inflation Reduction Act projects, Infrastructure Act projects. There's still substantial unspent ARPA money that's being spent this year and next year. That is stimulating demand for workers. So while workers' savings may be declining, their incomes are strong, and I think they're likely to stay strong. The consumer is going to probably surprise the upside, and the job market is going to be resilient. And the other structural issue we've got is a structural undersupply of oil and gas. And while we're aggressively trying to make a transition to wind, solar, and alternatives, and I think we need to do that, we still got a lot of demand globally and in the United States for fossil fuels. Workers need usually to drive a car to get to work, and they need to get paid more if they're going to put gas in the tank.
Can you layer in this heinous attack on Israel that took place over the weekend and how that will relate or not to any of the kind of conversations that you think happened in the room?
Well, anytime you have a horrible event like this, and also the prospect of widening, of escalation, I think it creates a lot of uncertainty. And I think when you have uncertainty and you don't know how this is going to unfold, the wisest thing to do is to stand back and not take action and let it unfold. So I think these recent events, horrible events, are more likely to augur for take no action than to take action.
I want to bring you back to last Friday, jobs report. We had a hot number, total number, in terms of employment or unemployment. But then when you started to look through it, people got a little bit more comfortable with it because they didn't think the wage inflation wasn't going up as much. You didn't see a cutback on the hours worked in the way that I think some people had been anticipating. Do you take that as a positive? Was that a hot number to you? What number was that?
It was a number to me that showed the cross currents in the economy. Away from government spending that's fueling demand for manufacturing projects and manufacturing construction workers and infrastructure projects, the economy is softening. And if it weren't for the government spending, I think it would have softened further by now. And I think we'd be a lot more confident that the Fed would be done raising rates. But maybe what's not being talked about enough, we have substantial amount, as I've said before, new manufacturing projects, usually public-private partnerships with the Inflation Reduction Act, infrastructure projects. They need workers, and they fuel demand for workers. And so what's happening around the country when I talk to companies, and particularly service sector establishments, they're competing with those projects to attract workers and to keep their existing workers. And so this dynamic appears like it's going to continue through the end of 23 and into 24. And I think these cross currents, I think a little bit were reflected in that number. And you saw the footprint of government-related spending also in that number.
We had Paul Tudor Jones sitting at this table just yesterday, and he said a recession is almost invariably in the cards. This idea of a soft landing, at least I think, I don't want to put words in his mouth, I think is just, in his mind, something that is almost it's almost a plane that's impossible to land. Do you agree with that at this point?
Yeah, I think the issue is when. And I think, again, without without the large deficit spending. And again, we just have gotten, for the year that just finished, we ran a touch below $2 trillion deficits. That's historically large, post-crisis, pre-recession. Normally you get those kinds of deficits in a recession. We're getting them now. And I think that government spending is kicking the can a bit or forestalling when a downturn will happen.
Yep.
But there's still going to be a downturn, particularly when the government spending dissipates. I think my only question is, it may happen later than people expect.
Okay, and that is a beautiful point that he's making. Why is everything taking so long, right? Why is everything taking so long? The government spending, the bailing out, the money in the system, liquidity. These are some of the reasons why the economy remains propped up, which is why I keep directing you guys' attention to here. This is the liquidity, the reverse repo market. You can see that here. This is going down. This is beautiful. Also, the mortgage-backed securities. This is what we need to go away, and it is. Things are changing pretty rapidly. Now, what I want to do, and I'm going to get to our Q&As here in a minute, but I want to show you guys something, once again, that has been frustrating me because, yes, I saw your comment, Johnny. I have already, obviously, that was the other thing I did this morning, is I already updated and read the Redfin report. So I'll have a video for you guys this evening on Redfin, all of the trends. But first, I want to show you and get you guys' opinion on something. Okay, here we go. All right, let me get your opinion on this right here. Now, right underneath me, I want to know, okay, what you guys think. Okay, so can you guys see that okay? Let me zoom in here because I really want you guys to see this because it's so frustrating to me. It looks like I zoomed in too much here. I am sorry, guys. So much good stuff I'm going to be reporting. You guys are going to get a good video this evening. All right, here we go. Now, here's the thing. From this point where my mouse is at right now, and I'm really asking you guys a serious question, okay? From this point where my mouse is at to this point right here, okay? So from this point to this point, what does the trajectory, I know it's small, you're probably watching on your cell phone, but what does that trajectory look like? Seriously, does it look like it's balanced? Does it look like it's going up? Does it look like it's going down? Again, just the 1 week from here to here, what trajectory is that showing? Because what I see is it going slightly up. At best, it's plateaued, okay? Would you guys agree with me that at the best, it's flat, but it looks like it's possibly going up a little bit. Would you guys at least agree with me on that? Okay? Because here's what frustrates me about Redfin. I really think they're messing with their graphs. I think they're messing with their graphs because median sales price went down again, $900. So instead of it, again, I'm looking at this right now, it appears that at best it's flat. At best it's flat, but it looks like it's going up. So it drives me freaking bananas when that happens because they're not showing us the true value decline in their data visualization. The only way for us to really see the value decline is to go in last week's housing market update. So when I go into last week's housing market update, we could see that house prices are again down week over week for median sales price rolling, 4-week rolling average. It's down another $900. But again, we can't see that here. We can't see that in the week over week. And I think that they're messing with these charts because it should be at least a slight downward trajectory, at least a slight, not an up trajectory. You guys, who do we depend on? I mean, it's just really frustrating out there. So let me take some Q&A, some questions and some comments now, and we'll get the show on the road. Let me just put my timestamp here. Anyways, I'll have that one for you guys this evening. I know it's happening. I know they're doing it. I can't really prove it. Megan, thank you. Someone's been buying memberships for people. I don't know if that's been you, Megan, but if it has, I really appreciate it. There's not a lot in my member section right now, but I'll probably give the members the first access to the home buying course when it's done, as it gets done. So I really appreciate that. Paul, I see you as well. Thank you, Paul. And thank you, Megan. So I'm going to go into this first comment right here. This is a good one. This is from Coors Light. Somebody I know refinanced their home in 2022 at 3.875. The same loan officer that handled the refinance just emailed them to see if they were interested in a reverse mortgage. I'm going to tell you guys right now, it's going to get cringy. In fact, it's already, to me, it's already cringy because I can see through these people, but it's going to get worse from here on out. And the reason it's going to get worse from here on out is because people in the real estate industry are making less and less and less money. So they want to try to figure out ways to get additional market share by offering exotic loans like a reverse mortgage. I personally don't like reverse mortgages. I think that people should just sell their house. It depends on the situation. But overall, I think reverse mortgages are awful. That's a program for elderly people that basically they kind of don't have to make their mortgage payment. It just depends how much equity they have. So here's a comment from FG. Thank you for commenting, sir. If you're not familiar with T-bills, just put your money in high yield interest savings accounts since they're paying out okay interest. And I really want to I want to yell and scream, but I really want to encourage you guys to just empower yourselves and find out how it works. Find out how to buy treasuries. It took me 18 minutes. I watched a video from Marco that does the whiteboards on how to buy treasuries. It's so easy to empower yourself. I'm making a few $200-300 a month because I learned how to buy treasuries. Now I purchase treasuries directly. So I go to Treasury Direct. And once you get there, you're going to say, is this a legit website? It looks like crap. Their website does not look official, but it is official. So that's what I do, you guys. I go, this is 1 month. It's really easy. YouTube has the ability to teach us so many things. Here's a great comment from my man, Don't Move. Don't move. I want to see you more often, man. I need you around, brother. You help keep me going, as do all of the people I love from the very beginning and even new people. But here's what he's saying. When you start seeing people pull out their equity with a refi and HELOCs and trading in their 2.5 to 5%, which is the 2019-2020 rates, to be able to stay afloat, once that reserve savings runs out, the foreclosures explode. And that's really what we've been following on these daily lives, is like that money is running out. It's run out for millions of Americans, but now we need it to run out in the economy. We need to run out in all businesses, and it is running out, but it's not out yet. And it's frustrating, but he's right. I mean, it's going to take some time to burn all. I mean, literally the Federal Reserve is burning money. They're burning it, right? Well, they just hit delete on a keyboard, but they're deleting money. It's really a crazy premise. All right, here's another comment. Thank you for commenting. I was under the impression that if you apply for a home loan, you have about 30-day window to shop without it affecting as much. Rumor, I was told. Now, let me explain this. So here's the thing. So when you get pre-qualified for a mortgage, is really important, first of all. And it's also really important that your loan officer runs your file through automated underwriting called AUS, Automated Underwriting System. And that if you want to make sure that they do that. And if they say they did that, ask them if they ran your file through LP or DU, which stands for Loan Prospector or Desktop Underwriter. But here's the thing when it comes to qualification for your mortgage. I tell people, like my clients, when I was originating, I would say your qualification is good for 1 day. Every one of my clients, your qualification is good for 1 day, because if anything changes, if you're late on something, you get a collection, anything changes, you don't qualify. It has a high potential of not qualifying for anymore. So I tell people 1 day, but here's the thing, man. So long as nothing changes with your credit, with your income, with your situation, you should be good for a substantial period of time. The reason why people say it's good for 30 days is generally because of an inquiry. A credit inquiry. A credit inquiry is when a mortgage company runs your credit and you get hit on your credit score from 5 to 8 points. When it comes to mortgages, not cars, not credit cards, when it comes to mortgages, there's a grace period. Now, some people have said that has changed, but the last that I was told, the grace period for mortgages is 30 days. So you have 30 days, and I'll double check this, but you have 30 days to shop your mortgage before additional inquiries harm your credit. So that's what they're saying. It's because of the inquiry, but I could tell you right now, so long as you're not in any more debt, your credit's not going down, you should be fine. And you don't necessarily have to repull credit and get an additional hard inquiry, dropping your score a little bit more. Okay. But again, the premise is the inquiry, is the credit report, because the credit report actually expires. Here's a question and comment from Dusty. Rates don't matter right now in the single family house market. So Dusty, I would say, I understand why he's saying that. The reason why he's saying that is people are still buying houses at 6 and 7%. But I'm going to say, Dusty, that interest rates absolutely matter. It's just those people that just bought don't realize that yet. I really feel like there's a high percentage, not all, but there's a high percentage of people that have just purchased properties that have no idea what they just did. They have no idea how unaffordable house prices really are, how unhinged the fundamentals on owning a house is right now. So I agree in part with what Dusty is saying. It's just like the consumers in the market felt it from June of last year up until about February. Then we had a Fed put situation with bank runs. There was a lot more money in the economy, a lot of home buying demand on the sidelines. But I will also 100% agree, Dusty. The high interest rates right now are devastating commercial, way more than residential right now. It's taking time to get there. But he's absolutely 100% right. It's crippling commercial. But also what's crippling commercial, Dusty, is the work from home. Like that work from home killed commercial offices, killed it. So it's a double whammy, actually. There's a lot of stuff. And here's a comment from my brother, Deuster. Deuster, I love you. Hope everything's going well for you and your family, sir. Thank you for being here from the beginning. And Deuster's the first comment champion. Here's his comment. Fed continues to combat this inflation until all the COVID money is gone. Then there will be a quick and shift crash when the average family spends all their money and can't keep up with the new pricing. And Deuster, I would argue like most families can't keep up with the pricing right now. It's just, this is sad. I mean, to say this, I mean, think about how sad this is. I mean, in order for us to win, in order for us to have the balance back in the housing market, people have to get absolutely crushed. Families have to lose their houses. Americans have to lose their jobs. It's a horrible thing, but he's not wrong. We know this is coming. We've known for the last year and a half this is coming. So why is it important to know this is coming? To prepare for what's coming. How do you prepare for it? Increase your credit, your income, your assets, make more money. All of these things we've been talking about the last year and a half. But I definitely agree with you, Deuster. I was surprised how much money was actually still in the market. Here's a comment from Arnold. Jeb and his friends are promoting 6-7%. I think that's 6-7%. 6-7 arm loans are really cool products that are available right now. I haven't watched that video, but I can tell you guys, it is. I can't watch their videos anymore. I mean, this guy's part of the cult. Jeb's part of this little cult. I mean, the reality is they're, in my opinion, and I think also from the data, their main focus on YouTube is to get you to call their phone, is to make money off of you from buying. If you don't buy, if you don't sell your real estate, they don't make money. So some of these YouTubers that I listen to, it's just like, they remind me of con artists. The way they're able to explain things and always wrap right back around to now's a better time to buy. Just buy now. You don't know what's going to happen in the future. Just buy now. Just buy now. It's always just buy now. And it's freaking slimy. It's so disgusting because I'm in sales. So I can see what they're saying. I see their angles and they're not being honest. They're not being truthful. I think it's absolutely disgusting. And for people to push arms right now, instead of pushing, save your money, be patient, right? Have the right mindset, use the data to find the deal. Instead of that, you guys, they're talking about how cool adjustable rate mortgages are because they are desperate to get their phone to ring because their business is dead. Their business is dead. And I've also seen YouTubers talk about how it's okay if you lose money in your house. It's not okay if you lose money in your house, especially if you have to sell. And then they say, well, it doesn't matter if you don't have to sell. Well, what if you have to sell? What if you have to sell? What if something happens that you didn't see coming? Think ahead, YouTubers, real estate YouTubers, think ahead. We see what you're doing. We see you're generating leads. I mean, honestly, guys, go to their descriptions and go and see for yourself. These guys are generating leads and that's the premise. They don't care about you. They care about them. We know that now. There's no surprise, right? We shouldn't be surprised about all this. I'm so sorry, guys. Here's a comment from Johnny. Johnny is my man. Okay. You guys don't know Johnny. Johnny's a little spicy. And I like that. Personally, I like that. Johnny, this is what he says. Keep in mind, during election years, real estate usually cools down. And that to current market conditions, he's thinking Q3, Q4 of 2024 is when it's going to start really getting wild. He's probably right. The election year is pretty scary. I don't think they can even have this housing market propped up that long. Do you guys think they can have the housing market? Oh, Deuster, I see you. Do you guys think they can even make it to elections before the housing market crashes? Comment below. Let me know what you think. Here's a comment from Melissa. Melissa, we've been all worried about you. I'm also worried about KOV. When I don't see you guys, especially all of my mods, I start to get worried. Trey, I love you too. You're almost going to make the mod, Trey, but you're not going to make the mod yet. But soon, Trey, soon you will. But Melissa, I hope you're doing well. I hope your family is good. You are loved, you are important, and you are appreciated. And I thank you for your comment. Now let's see what she has to say. How will the Israel versus Palestine situation affect us here. A lot of military age men are coming here. $10,000 a month. They have a lot of them held up in a hotel in New York, room service and luxury hotel house. I'm gonna probably get some hate here, but I will happily help lodge these people. Would you guys, I never shared this with you guys, but my mom converted. My mom remarried. Parents got divorced. My mom remarried, and she married an attorney that was Jewish. So my mom converted to being Jewish, and I was always Christian. And I have to say, I have developed such a love, a tremendous amount of love for Hebrews, for the Jewish religion. They took me in as a Christian, and they, and I was always talking with the rabbi, like, why don't you believe in, like, you believe in Jesus, but why don't you believe he was the Son of God, right? Like, you acknowledge it. So they treated me with love, and I have really, man, they're just good people. I mean, I have I know so many Jewish people that are in Israel. I mean, I could say some prayers. Baruch atah Adonai Eloheinu melech haolam asher kiddushanu b'mitzvotah. Anyways, I need a little bit of brush up with my Hebrew prayers. But you guys, I love people and what's happening in the war. That's why I couldn't do a Monday live. My mind and heart was wrecked, and I was like, I can't face people today. So anyways, how do I think it's going to affect our housing market? I don't think it's going to affect it a lot. We've already seen the effects, Melissa, a little bit, which was the flight of safety into the 10-year, which dropped mortgage rates slightly. I don't think it's going to have, so far, I don't think it's going to have too much of an effect outside of that. But if it gets real bad, if there's another war in the Middle East, I think it's going to cause inflation to go up. And it will also probably cause the interest rates to go down, both of which we don't want. So that would be very bad. But right now, I think that so far the results are kind of in the 10-year now. I don't think we'll have much further to go as far. But again, we don't know what's going to happen. Deuster, I love you, man. Thank you so much. Who wants Travis to do boots on the ground in Florida and Southeast? Let's go. Let him know in the chat. I want to get out in Florida, Deuster. I already know where I would go to start out Florida. I would go to Pensacola. All right, y'all. Boom, boom, boom. You guys, we got some great people here. Let me throw some names up on here, just some appreciation. If you guys see Johnny, show some love. You guys see Melissa, this is my girl, show some love. This is my man, Florida Beach Bum. This is my man right here. This is Trey. Trey's a little bit of a mess right now. No, you're not a little bit of a mess, but I'm worried about you, Trey, because Trey's right now, he's looking for a house. He's actually shopping for houses, putting in offers right now. And I keep asking him, what's the price, right? Like, what's the wedge? Trey, I want you to email me the market analysis. But he's a great man. House hacker as well. Love you, house hacker. I know we don't always agree, and that's okay. We make each other, I feel like we make each other stronger, house hacker. And you know why? I love so many of you guys so much, like, house hacker, but also Jeff, also Johnny in Vital Signs, who we haven't seen, and I'm really worried about Vital Signs. I call him on the phone. They're in incredibly tight markets. You guys help keep me grounded. Texas is falling apart. Wait until you guys see the Redfin update that I'm about to give you. Texas is all messed up. So they help me see what's going on around the rest of the nation. And here's Megan. Megan's in a similar, she's this close to purchasing. So just remember, patience, data to find the deal. Proper expectations. It's okay to wait. Okay, Megan? Can I start a Discord? You guys, I don't even know I'm a one-man army. Megan is so, I can't, I'm not doing any other social media until I'm done with that course. I'm not doing, and people were like, can you do consultations? I'm not doing anything else until I've given back to you guys. I'm not doing nothing. I'm not even going to respond to most of my emails because my priority right now is those home buying courses, because we are right this close to having to use those skills to buy a house. So that's going to be my priority. But maybe it's just so hard, Megan. It's so hard. And then I also balance my time with my family because I love them and I don't want to miss out on that. And I also have health issues. So I don't even know if I'm going to be around in 5 years. I have Lynch syndrome. It's a colorectal genetic precancerous condition. I live life a year at a time. That's probably why I'm so kooky and crazy. I don't know. Or I'm just kooky and crazy. Who knows? Also, Mark, don't move. Don't move. If you guys see KOV, give KOV some love. I don't know where KOV is. FG, always nice to see you. Obviously, you guys know Christy. You got JG from the beginning. Luke's always nice to see you. There's my man Trey. You guys already know Trey. MFH. There's my man MFH from the beginning. I remember all of you guys. It's just I don't always have time to respond, but I have never lost any love for you guys. And again, remember what I want for each and every one of you that's watching. I want you to help me with my legacy. And my legacy is empowering and teaching. So that's what I want you to walk away with. So what should you walk away with today? I hope what you're walking away with is confidence in your decision to be patient. I hope what you walk away with each and every video is a better understanding with credit, income, assets. I hope you're watching my videos and understanding how to research your local housing market. And I believe as a community, that's where we're falling and failing the most. As a real estate mindset community, we're failing with our market analysis. And I see that from that. We're doing great with the credit. Great job with the credit, guys. Pretty good job with saving your money, but we need to step up with understanding how to gather the data. I know that's incredibly difficult because most people don't have access to the MLS. But just because it's difficult doesn't mean it's not incredibly important. And I've told you what to do if you do not have access to MLS, which is get a realtor and use the market analysis as a way to do a job interview for a realtor. But anyways, guys, I'm sorry for being so sappy. We got one more live to do tomorrow, which is Friday. I love all of you guys. Johnny, be good. Thank you guys for all of your support. And I am getting out of here and I'm going to start working on our evening video, which is going to go into the Redfin housing market update. Understand, you guys, if you are on the sidelines right now and you're empowering yourself and you're improving yourself, you're perfect. Don't let anyone tell you otherwise. And if you're out there investing in real estate, you guys already know I wish you luck and I hope you win.